Hello, this is Jordan, and this is your precious metals video market update. Today is Tuesday, March 10th, 2015. And first, let's start off here with a chart that compares the 1996 to 2000 bear market in the gold stocks to the current bear market. And we're looking at the Huey Gold Bugs Index. And obviously, given the intense sell-off in recent days that we've seen in the gold stocks and precious metals, it looks increasingly likely that they're going to continue to go lower and make new lows. Now, the last video I did, I posited that, well, the Huey or GDX has about 18% downside to its recent bottom. Perhaps it can make a huge double bottom there. And while that's still possible, the real strength of the sell-off over the last week has really, not to put it mildly, but has thrown that idea out the window. We would need to see a massive reversal and a huge rally immediately almost. And so, anyway, looking at this comparison, one thing I want to note is that over the last 2 months of that bear market, the 96-2000 bear market, the Huey declined 34% in the last 2 months. Go back to 2008, I think the Huey declined something like 50% in the last month. Obviously, there was a financial crisis going on. But the point is, these bear markets can get really, really ugly at the end. And given how things are trending, I mean, that looks increasingly likely. And that's why in the last weekend update I did for subscribers, I said, listen, this is a potentially really dangerous situation. You really got to protect yourself because there's danger and potential big losses ahead. I mean, even if it's 20 to 30% losses, that's still, I mean, that's a major decline. And when, one thing I point out when investing in precious metal stocks, one thing I like to do is have a 20% stop loss. So for example, if you take a 5% position, you have a 20% stop loss, you limit your risk to 1%. So I know it's tough for people to sell losses, but this is common sense stuff to the best traders out there. And this is a sector where you have to be prepared to take your losses and understand that, look, the bear market's not over yet. And it looks, obviously we're nearing the end, but that last inning can be really, really ugly. So you have to be really careful. But that being said, in the very short term, we're nearing the lows. The metals are close to their 2014 lows, the lows that were made there in October, November, for gold and silver, and also the stocks. So it is possible, I shouldn't say possible, it is probable over the coming days that we should see some kind of a bounce. But when that bounce peters out, it could get ugly. So be alert and be careful. Now looking at gold here, this is a weekly line chart, and at the bottom we have two indicators. We have a rate of change indicator for the last 12 weeks, and then we have a moving average differential indicator where we're looking at gold's position compared to the 20-week exponential moving average. Now let me first go to the price action in the main frame, and we can see that gold has been trading in this channel there you see in red, and it's been sloping ever so slightly down. Now gold right now, it does have weekly channel support around 1150, so if we do get that bounce, it's not going to break down, but you should still be alert, because when gold breaks below this channel, you could see an accelerated sell-off, maybe to 1080 to 50% retracement. And there's basically strong support from 1000 to 1080. So now looking at the indicators at the bottom, the rate of change indicator for the last 12 weeks is currently at about minus 3%, minus 20% there. I've shown in yellow. That's marked recent lows as far as the indicator. Now looking at this chart going back to 1970, those are levels that are very extreme, excluding the crash in 1980. So looking at as far as when is gold going to become extremely oversold, obviously there's tons of things we can look at, But just looking at this indicator, it tells us it's got to get close to that 20% mark. Then if you look back up top, you can see a 20% decline over the next 7 weeks or so. That would put gold there at about 1050 or 1060, something like that, at the very end of April or maybe early May. And that would put it in the range of 12 weeks. So that's something to keep in mind. Now, the second indicator, looking at gold's distance from its 20-week exponential moving average, it's only less than 5% away right now, and you can see that to be really oversold, it's got to get down to about 15%. So gold is definitely oversold, but zooming in on a more near-term basis, it's not that oversold, and that's why if we have a bounce, that could potentially set up a accelerated decline where things get uglier. Now, looking at the US dollar, up top we have two rate of change indicators, and at the bottom we have those moving average differential indicators. A lot to go over here, but first let's look at the price action. And the US dollar, since it broke above there in the high 80s, that resistance, and also the resistance there at about 92, there isn't real strong resistance. So the dollar has gained momentum, and it hasn't moved yet to a point where it could face strong resistance. The same thing can be said about the euro and its weakness. So looking at the dollar, I've pointed out some support here, maybe around 104, 105. Excuse me, that's resistance there around 104, 105. So this move can continue. Now, if you go to the bottom, based on those moving average differential indicators, we can see that gold is extremely overbought. I mean, if you look at the 40-week, gold is inches away from being the second most overbought in its history there. Then as far as the 80-week indicator, gold is already the second most overbought. So extremely overbought. But if you look at the rate of change indicator, we look at the 12-week there up top and then right below the 3-year. Let's start at the long term. Look at the 3-year indicator. That now is approaching potential highs. It's approaching the levels that were peaks there in the late 90s and the early 2000s. But of course, the highest was there in the mid 80s. That was above 40%. So looking at that, gold is not, I mean, it's obviously very overbought, but that indicator doesn't tell us it's going to crash right away. I mean, maybe if it went up a lot more. But looking at the top there, the 12-week, as far as a very short-term indicator, gold in recent weeks was not quite at an extreme. Now it's almost at 10%. If that pops up to 13, 14%, obviously that would help the 3-year rate of change indicator. And in both instances, the US dollar, I think I said gold earlier, the US dollar would be a lot more overbought based on these indicators than it is now. So obviously in the months ahead, I'm looking for a counter trend move, a big counter trend move. But right now, the dollar has to run into some resistance first. And so 104, 105, that is a level to keep in mind. Now let's look at gold's bear analogs. Silver and the gold stocks have been very extreme with their bear markets, but gold has not been so extreme, and that is why this bear market has fooled many people, including myself, and just continued to go on. Now the current bear is in black compared with the other bears, and we can see that it's followed the 96 to 99 bear quite closely. So looking at this, I mean, this tells us that gold can continue for a little bit longer before it really looks extreme. So, I mean, this is something to keep in mind. I mean, the 1,000 target, that's a strong target. And, I mean, that's a logical place where this could end. Going back to what I said before, if we get a weekly close below 1150, then we could trade down to 1080, maybe bounce again, go below. Once we go below 1080, assuming we continue to trend down, that is going to be, I think, the point when we're getting closer, a lot closer to the bottom as far as days and weeks. But right now, we're not there yet. Now, obviously, the gold stocks have been a dumpster fire over the last 4 years if you've held them. I mean, if you've traded them, you've done better, but you still found it really, really difficult to make money, especially on the, I mean, if you've been on the long side. Now, here I've looked at the weekly data from the best recoveries in the gold stocks. We're looking at the Huey from 2000 and 2008, and also the Barron's Gold Mining Index in 1982. These were three of the worst bear markets. The Barron's Gold Mining Index 1982, that followed a real quick, severe bear market after gold went parabolic and after the secular peak. So following that initial bottom there in 1982, the Barron's Gold Mining Index rebounded over 200% in 7 months. Then it went back down after that. But you can see, extreme bear market, had a huge rally. Obviously, if you're familiar with gold stocks, you know what happened in 2000, 2008, following those bottoms. Following 2000, in 18 months, the Huey rallied 293%. Following 2008, the Huey rallied 180% in a little over a year. And I should also mention that the analyst Bob Hoy, in 2009, he looked at the components of GDXJ and he found that data and looked at it backward to 2004. And following 2008, the year following that, GDXJ rallied about 250%. So these huge gains, we haven't seen them during this bear market. I mean, we've seen strong rallies within a period of a few months, but going forward, if we do get this final decline, Huey support at 150, maybe it breaks below that, maybe it bottoms at, who knows, 120, 100, 115. That's why you have to be really careful, because it can just continue and go a lot lower. But at the same time, you have to be very vigilant, because if the market gets extremely, extremely oversold, you can take a chance, have your stop in there, and if you can catch the bottom, you don't even have to catch the bottom. You can miss the first 20, 30, or 40%. You're likely to see excellent gains, based on what follows a really nasty bear market. You can follow my work at thedailygold.com. Thank you, everyone, for listening and watching, and I wish you all the best in the weeks, months ahead, and for the rest of 2015. Thank you so much.